5 months ago, silver was making history. It surged to around $121 per ounce, the highest nominal price ever recorded. Investors were excited, social media was full of bullish predictions, and many believed silver was only getting started. Fast forward to today, and silver is trading near $67 an ounce. That's a decline of roughly 45% and one of the sharpest pullbacks in years. So what happened? And does this mean the silver bull market is over? Let's rewind. At the beginning of 2025, silver was trading near $30 an ounce. Over the next year, prices exploded higher, eventually reaching about $121 by early 2026. That's a gain of nearly 280%. Then momentum broke. 5 straight weeks of losses followed, and investor sentiment shifted dramatically. The same people calling for silver to go to the moon suddenly started predicting disaster. But this wasn't an ordinary correction. Silver had risen from $30 to $121 in just over a year. Markets rarely move that fast, without a major pullback. Even after reaching a nominal all-time high, silver remained below its inflation-adjusted 1980 peak, which would be close to $200 per ounce in today's dollars. In simple terms, the market became overheated. The real question isn't whether silver fell, the question is why. 3 major factors hit at the same time. First, commodity exchanges increased margin requirements near the top of the rally. That forced many leveraged traders to sell positions quickly. Second, the Federal Reserve maintained a hawkish stance. Higher interest rates and a stronger dollar reduced the appeal of a metal that generates no income. Third, improving geopolitical sentiment reduced demand for safe haven assets. Together, these factors triggered a wave of selling that pushed prices sharply lower. Importantly, none of this changed silver's industrial value. And that's where the bigger debate begins. The long-term bullish case for silver has always been based on supply and demand. The world continues to use more silver than it mines, driven by demand from solar panels, electronics, and other industrial applications. Industry forecasts still point to another year of supply deficit. However, some analysts have recently reduced their deficit estimates, arguing that higher prices have weakened demand in certain sectors while encouraging additional mine production. In other words, the deficit still exists, but it may not be as severe as many investors expected during the rally. That matters because the idea of extreme scarcity was one of the biggest drivers behind silver's surge. So what should investors take away from all of this? If you're a long-term silver holder, a 45% correction does not automatically end a bull market. Commodity bull markets often experience deep pullbacks before continuing higher. At the same time, there is little evidence that the market has reached a definitive bottom. Many analysts expect a period of sideways trading rather than an immediate recovery. That means patience may be more important than trying to catch every dip. The silver story isn't over. Industrial demand remains strong, supply remains tight, and long-term fundamentals are still attracting attention. But the speculative excitement that pushed prices to record highs has cooled significantly. The next major move will likely depend on interest rates, economic conditions, and whether demand continues to outpace supply. For now, silver remains one of the most closely watched commodities in the world, and the coming months could determine whether this correction becomes a buying opportunity or the start of a longer consolidation phase. As always, this content is for educational purposes only and should not be considered financial advice.